It's been a terrible few months for the oil industry. Demand for crude oil, already reeling from the impact of last year's trade war between China and the United States, declined even further as the COVID-19 pandemic spread across the world. Then Russia and Saudi Arabia sparked off a potential oil price war by refusing to come to an agreement on production levels. As a result, US oil prices went into negative territory for the first time in history last month, amid the deepest fall in demand in 25 years.
With a huge impact of COVID, I think, which has destroyed the demand anywhere between, I would say, 20 to 30% for crude oil per day, depending on which country or region you talk about. So clearly, I think this is unprecedented time for the oil sector. And the oil trading sector is not immune to this.
Like most commodity traders, oil traders rely on a low-margin, high-volume business model, and with demand falling off a cliff, volumes remained low. In its latest half-yearly macroeconomic review, the Monetary Authority of Singapore, or MAS, said that the wholesale trade of fuels is of concern due to the size of the industry. It had an operating surplus of 13 billion Singapore dollars in 2018, accounting for 4.7% of Singapore's total gross operating surplus. MAS warned that these industries could be impacted by contagion effects if the situation worsens.
Because of the stress, some of the companies which were not necessarily well managed or did not have robust risk systems, governance frameworks, have defaulted. The worry is there are more than 130 companies in Singapore which are in this sector, and all of them have their lines of credit with banks. The worry would be that just because a few have failed, the bank starts pulling the loan from others, which will lead to a contagion effect of those firms also failing.
Things came to a head when homegrown oil trader Hin Leong Trading filed for bankruptcy protection last month. To make matters worse, reports came to light that founder Lim Un Kuen had directed the firm to hide nearly $800 million in losses from speculating oil futures over the years. In response, MAS said in a joint statement with Enterprise Singapore and the Maritime and Port Authority of Singapore that Hin Leong's financial woes would have no serious impact on Singapore's oil trading and bunkering sectors, a sentiment that is echoed by market watchers.
The issues were very company specific. Most of the other companies, I would say, are very well-run companies. And it's like that. If you are heavily leveraged, you take more risk than you need, then there's often a price to pay when things go down.
Others pointed out that such issues are by no means confined to the commodity space and could result in the industry coming out stronger.
If you look at any sector, I think there are always, I would say, some companies which fail due to various reasons. So what's going to do, obviously, is there will be more regulatory oversight, more demand for corporate governance. So these are some of the things, I think, which get strengthened. And what this means also is there could be more consolidation, and maybe the smaller unviable guys, the marginal players might lose out. Either they have to exit the business, they have to exit the market, or they have to kind of get subsumed by a larger player. So those are the typical, I would say, industry realignments which happen after any major crisis.
In the latest such sign, HSBC filed an application to place Singapore-based oil trader Zenrock under judicial management. Still, in the long run, most experts are optimistic about Singapore's ability to recover.
The conditions or the factors that actually cause us to grow are still I would say, there, taking COVID-19 aside. We have highly liquid dollar market here, and we have very favorable policies that would allow all these companies to grow here. And all these factors are still there.
Others note that some countries are beginning to open up their economies, and this might mark a turning point in the decline for oil demand.
Are enough people coming out? Are they using the cars? Are they traveling to work, to, I would say, other places of necessity? I think we will not go to see huge leisure travel yet, but even travel for necessity, travel to work, I think travel for key, I would say, critical functions, I think still has to come back. And if that comes back, and that comes back in a very safe and secure manner, in a phased wise, and then we don't see a second wave as many people have been, I would say, worried about in terms of the whole COVID epidemic, then we can safely say that, yes, I think probably the worst for the oil market might be behind us.
Others say the future for Singapore lies in evolving from an oil trading hub into an energy trading hub.
Fact of the matter is, thanks to renewable energy, energy efficiency, and climate change concerns, oil is going to decline in consumption. Right? Over the next 2 decades, we believe that a bulk of fossil fuel based energy will be replaced by renewable energy or new fuel like hydrogen coming and taking the place. So given that situation, I think we have to move beyond ourselves being oil traders to becoming more energy traders or new energy traders. And as long as Singapore can aspire and prepare the groundwork for creating a proper energy ecosystem, I think those things will help Singapore to continue to sustain our status as an energy hub rather than only an oil hub.